Google, aka Alphabet, came out with earnings last night and they made a pretty big announcement for what they're going to be doing with their $130 billion cash hoard. So, what is that? Well, let's spend the next 10 minutes trying to find that out and whether or not it's going to affect shareholders. My name is Brian Stoffel. At the time of this recording, I do own shares of Google, and thanks to YCharts for sponsoring today's video. So this was the company's first quarter of 2023. It's about $1.4 billion. On the top line, revenue grew 3%, which is pretty slow. However, it beat Wall Street's estimates. On the bottom line, earnings shrank to $1.17 per share, but that was ahead of Wall Street's estimates. Margins, not a lot to get excited about. Gross margin ticked down ever so slightly, but operating margins were down meaningfully. Net margins down to 21.6%. When we look at some other numbers, it gets more encouraging. Free cash flow actually grew by $2 billion. A big part of that was the fact that there was fewer capital expenditures. Net income was down slightly, and that balance sheet is very strong at $146 billion in cash and only $14 billion in debt. More on how they're going to spend that cash in just a minute. Let's go down each segment line. Google search was up 2%. The company said there was more advertising in retail and travel, less in finance and media and entertainment, so they kind of canceled each other out. YouTube ads were actually down about 3%. However, management was a little bit encouraged that there's some stabilization in advertising there. The Google network was down 8%, and that was mostly because of just a pullback in advertiser spending. Google's other revenue came up 9%, and that is primarily because of strong growth in YouTube subscriptions. And the Google Cloud continues to be a star. It was up 28%. It also generated an operating profit during the quarter. Now, total acquisition costs were down 2%, which is actually a pretty good sign. However, there was a story worth mentioning over the past week, and that was that Samsung, major maker of smartphones, was considering replacing the Google search app with the Bing search app. Bing is Microsoft's search engine, and it has partnered with ChatGPT. More on that in a second. And that is a major threat. Samsung ended up not doing that, but hats off to Ross Sandler, an analyst who kind of cut through the BS and just asked the question everybody was wondering. How do you feel about Alphabet's ability to maintain their unit economics in light of Microsoft's ambition in search? And to his credit, CEO Sundar Pichai gave the best answer that he possibly can, which is, what's always served us well is building the best product that gives the most value to users. It's a win-win-win-win for everyone involved. But that is what we need to keep our eye on. Now, you'll also notice that the number of employees was up significantly. That will be coming down because most of those layoffs weren't fully into effect by the end of March. About 12,000 will be coming off of that moving forward. Looking at the income statement, you got to remember revenue is only up 3%. So R&D and sales and marketing being up 26 and 12% respectively is not sustainable, but the company did mention that there was $2.6 billion in extra charges related to those workforce layoffs. Some of that was canceled out by about $1 billion benefit from saying that its servers can last an extra year. Now that's magical accrual accounting benefit, not a cash benefit, and there was a shift in when some of the stock-based compensation went out. Speaking of that, the number of shares fully diluted was actually down 4% from the same time last year. And here is the big announcement for how Google is spending its cash hoard. The board of directors has authorized the company to repurchase $7 billion of Class A and Class C shares. That accounts to about 5% of the company's market cap today. Now, a company does not give guidance for the current quarter, the second quarter of 2023, but Wall Street sees 4% top-line growth, 6% on the bottom line. For the full year, 5% top-line growth, 10% bottom-line growth. When we look at the company, what to watch moving forward, results in ad growth is key. We know that market has been depressed lately as companies are worried about a recession. Keep an eye on margins. The cost-cutting effects have not fully gone into effect. The overall market share is a big one, and I'll get to that in a second, and free cash flow. Never thought I was going to say this, but I believe that the moat is stable. It's not growing because, look, ChatGPT is an existential threat. Doesn't mean that it's going to be the end of Google, but it is something we now have to keep our eyes on. Google's key moat is low cost production. It gets at low cost production because it collects data with 9 different tools that have over 1 billion different users, and that allows for better ad placement. If ChatGPT takes away some of that data, then that low-cost data moat starts to disappear. It's not clear if that's going to happen, but that is the thing that we need to keep our eye on moving forward. Now, because of that, I've lowered the anti-fragile score for Google because of that low-cost production question, but also because it has been a long time since we've seen anything the company develops move the needle in terms of revenue. Now, I know acquiring YouTube, super smart, that has worked very well. But all those other bets, we've really not seen anything that affects shareholders in its entirety since it started. So it's there, but you'll see that it'll change in a second. Now, if we look at valuation, we think that this company is fully optimized up and down its income statement, which means that it's in stage 4 or stage 5, the capital return plan, which means that we can look at its price to earnings, price to free cash flow, its shareholder yield, and its dividend yield. And for that, we turn to our sponsor, YCharts. Head on over to YCharts if you're interested in giving YCharts a try. It's a tool we use all the time. See the show notes, click on the show notes below, and you can get a discount on your subscription. Now, the company's PE ratio currently sits at about 23. That'll change a little bit depending on what the stock does today. That's reasonable, and it's also low in Alphabet's history. Same story with price to free cash flow, sitting at about 23. This is going to go down a little bit once that data gets ingested. The company does not have a dividend, so we don't have a dividend yield to look at, but it is worth looking at a shareholder yield. And again, what a shareholder yield is it's not just the dividend, but it's debt pay down and stock buybacks. And so if we look at that, we see one of the reasons that Google is attractive, because its shareholder yield before any of these $70 billion in buybacks was 5.2%. So it would not be surprising to see a return to shareholders via that buyback of over 5, over 6, maybe even over 7% moving forward. We'll have to keep our eye on that to see. Overall, that all looks very, very appealing. Now, we can also go ahead and do a reverse discounted cash flow analysis of the company. To do that, we head on over to the reverse DCF tool that we have built. We type in the ticker symbol right here, GOOG, with the change in free cash flow that was just reported. It's got $62 billion in free cash flow over the trailing 12 months. If we put in a terminal growth rate of about 2%, a discount rate of about 9%, we see that the company really only needs to grow its free cash flow by about 7% per year moving forward. And it grew it by more than that in the most recent quarter. So because of that, that actually seems pretty appealing. And I am willing to then go and raise my score by an extra point to a 12, putting this in that anti-fragile category. But make no mistake, this is a company that is under pressure right now. That pressure is reflected in its price, but it's not a stock that I'm going to be adding to. It's not a stock I'm going to be selling, but I am going to be watching, because we've got to see whether or not it all comes down to whether that low-cost production of data moat is being encroached on. If it is, then this stock is cheap for a reason. If the company is able to adjust, or if the threat is overblown, then it's not really a broken company, it's just a broken stock. We'll have to check back in 90 days to see whether or not that's the case. If you're interested in using the reverse DCF tool, see this link in the show notes below, and you can download your own free copy there. We'll see you again in 90 days. Brian, out.